What's going on, Moon Gang? The interview you're about to listen to is with Dave Lauer. Now, if you don't know who Dave Lauer is, he's a pretty smart cookie. He happens to be a market structure and high-frequency trading expert. In the past, he's appeared in front of the Senate Banking Committee and also on various SEC panels, so he definitely knows what he's talking about. Now, in this particular interview, we discussed many things, including the GameStop report, the Citadel Securities versus SEC lawsuit, and we spent most of our time talking about how the apes can win the fight for market transparency and fairness. And one of the things that really blew my mind, and we talked a lot about it, was how the insanity of GameStop back in January truly presented an overall systematic risk and could have potentially brought the entire Wall Street establishment to its knees. It's definitely a worthwhile listen. I hope you enjoy. Welcome back, Mr. Dave Lauer. We appreciate it. I think this might be time 48 with you joining us to really express what's going on. And I'm just excited because you're always a wealth of knowledge and it makes sense. I mean, you've talked to the SEC panels, you've talked to Senate Banking Committee about all this, and it is always a treat when you're able to share your knowledge. And it just feels like October's been crazy in relation to what's going on with your expertise, the market structure, the ape community. So a lot of things I want to talk about. And if we could just kick it off, the GameStop SEC official report, that good thing we never held our breath on because we would be dead by now, finally came out on October 18th. And now that we've had a little bit of time to process it, I know at first there was a bit of frustration. People felt as if in a weird way it was neutered. I don't know if it would even really count as a good faith effort, but could you just, the high level of what are the main takeaways of the GME report for you that you're like, hang on, this is a bit interesting. It might be worthwhile to dive into more.
Mm-hmm. Yeah. And thanks for having me, Matt. It's great to be back and, good to be talking to everyone. And as I always say, it's still so cool that everyone's interested in market structure. And I love talking about it. So, my first reactions to the SEC report were that it was watered down. It really, the first part of it was like a market structure primer, which cool, that's great. The more we have of that, I guess that's great. I think it's important that people learn about this stuff, obviously. But I thought the report itself stayed at a very high level. And in fact, even as I mentioned to you, rereading it recently, it didn't really get into the meat of the issues as I had really hoped it would. It talked about, was there a short squeeze in GameStop? Was there a gamma squeeze? Was there, and so let's take the short squeeze question and the report, actually, let me see, because I have it up here and it said something actually that kind of jumped out at me. Where is this on page 30? It said, while a short squeeze did not appear to be the main driver of events and a gamma squeeze less likely, the episode highlights the role and potential impact of short selling and short covering. Now, that's a really interesting way of phrasing things, right? Because it's actually completely non-committal, right? It's did not appear to be and less likely. But you would think that they could have been much more definitive. Was there a short squeeze? Not the appearance of one, And then if you look at the charts, something is not quite adding up to me. So what I was looking at earlier today was figure 5, which is the short interest in GameStop on page 27 and figure 6 on page 28, which breaks down how much volume was just straight up buying, which is essentially FOMO, and how much of the volume was short sellers covering. And I might be missing something here, which is plausible, but you see short interest at more than 100% of the float. But if you look at the size of the bars of short seller covering on figure 6, it doesn't even look like it comes close to adding up to the float. And yet they show the short interest dropping from well over 100% down to something like 20%. So essentially the float would have had to have been bought to cover, and it doesn't look like the numbers add up. So something about it is still not adding up to me. I do think that the biggest thing in terms of trading dynamics that jumped out to me and continues to jump out to me is this notion that anywhere from like 3 to 4 to 5 times the float of GameStop was trading per day, and this happened multiple days in a row. I spoke with a friend of mine who has been in markets far longer than I have, and who thinks that these events are he really buys into the SEC's explanation. And so, I think you always have to consider there are obviously two sides to these arguments. But even he admitted, he's like, sometimes when there's an IPO, you'll see twice the float trade. He's like, he's like, I've seen that before, but 5 times the float, I haven't seen that before. And while all of us kind of understand technically how that can happen, mathematically how it can happen, it doesn't quite make a ton of sense at a qualitative level. It's like quantitatively, we can understand kind of the theory that would get you there, but qualitatively, it just doesn't seem right. So, these things still stick out to me. And then there was more in the report about the clearing agencies and the margin calls, capital calls, which certainly fueled a lot of instability, the disabling of the buy button, which, while extremely controversial in the ape community, as it should be, is also, I think I should tell you, controversial outside this community and on Wall Street. I think that some people would call that market manipulation. I don't think you'd be off by that. Instead of halting the stock, they disabled buying. That's I've never seen that happen before. And again, I talk to people in the industry. I still have friends all over, and a lot of people are coming around to the idea that something really extraordinary happened, and they want to understand better why and what. So I don't think this is over. I think the SEC report, was maybe step one, but it really feels like there's a lot more digging that needs to happen here.
Okay. And with that, I really want to dive into one thing you just said there, that with your years of expertise, like following the markets and all of your entire network that's very grounded in Wall Street, no one's seen this before. That type of a one-sided PCO thing where like some brokerages are trading it, but we know from the report that it was a retail-driven thing at that moment in time, especially in the US. Most retail was like clearly located on Robinhood. The fact that they could do this one-sided, like I've never seen it, but that's not too special. I'm 27. I haven't been trading for that long. But the fact that so many people are coming here and saying, this is ludicrous, with like hundreds and hundreds of years of total, like just stock market experience. I just really want to drive home that point. Additionally, from there.
But honestly, like to that point, when you really kind of dissect it, I think what you see is that in that moment, in that January moment, retail was right. Yeah. The apes were right. They were spot on. And there was an opportunity there to squeeze that thing. And as Petterfee came out and said, and several others, again, that I've talked to since then, like that the risk that introduced and exposed in the system was pretty dramatic. And, again, from other conversations, like firms, the intermediary firms, like the internalizers, had never seen that kind of unidirectional flow. So this really was essentially like a black swan kind of event that took a lot of people by surprise. And, once again, you sort of had essentially a bailout of the firms involved. The firms came together and protected themselves to the detriment of retail. And so it is not surprising that people are very angry and upset over that. And not only that, but there were people that bought at very high price levels because they were right? Like this thing was going like parabolic. And, they might have lost a lot of money. And for them to think that this doesn't seem right it's not a surprise.
It's so wild to me because as I sit here and we're slowly putting together the puzzle pieces of this story, it's that thing that you just commented on from Thomas Petterfee. Those of you who don't know, a highly respected market structure engineer, owns Interactive Brokers, created it, a lot of commentary. That comment was from February where he said this was a systematic risk. And that's crazy because those are just two words we say. just throw it out there, systematic risk. But when we think about it, that's insane. One stock, GME, had the potential, like, and this is where I'm like, okay, is my tinfoil hat a little bit too tight right now? But it had the potential of really, really messing things up, potentially bring it to a complete halt. And I get it. And I'm of the opinion, I do not have the evidence of this, that there had to be some sort of conversations. Citadel Securities, clearing brokers, Robinhood, the SEC, they might have been knocking on their door and saying, we have one of two options. Let the market fall and we'll see if it completely collapses, or we're just going to screw over a bunch of retail. That's a tough decision. I get that. I'm very happy I did not have to make that decision. But I think people like myself, and I believe you, we're trying to say, we should have never been there. Like, that should have never been the binary option. It's just, and to me, and I would love to get your thoughts on it, the reason we got there, a lot of it is because so much power is concentrated in too few of players. And I'm obviously referring to Citadel Securities and Virtu. They bragged about it and you called them out of like, you're happy? You're the only one who continuously provided liquidity? Yeah. That's not good. We should not be relying on that. Am I completely off base, or like, is my hat a little too tight, my tinfoil hat, or like, I guess like what?
It's only as tight as Thomas Petterfe's. I mean, that's what he came out and said, right? That was when someone like that, and you know, again, people who are new to markets, they might not know who he is, or they might just have recently been introduced to him, but like, he's a giant in markets. This is a guy who, I told you before, you know, like, he built his own trading tablet to do options market making in the 80s on the floor when things were still being traded by paper. You know, there is no one who knows more about markets than this guy. And that was one reason why such a statement was extremely meaningful and impactful to me, because if he sees it, then there must be something to it. And then again, in my conversations with people, very senior people that know more than I do, they agree with him that there was a systemic risk. And so, to be frank, and I'm not saying it's what the ultimate action taken was right, but if regulators are not on the phone with clearing agencies and a systemically important firm as the prospect of U.S. markets grinding to a halt is unfolding, I think that would actually have been irresponsible. So I find the denials a little strange. You know, during the great financial crisis, we know that regulators and exchange executives and institutions, the biggest banks, were all coordinating closely to try and keep the U.S. economy from falling to pieces. The fact that, you know, a video game store stock could have ground U.S. markets to a halt is a very bad thing. Let's not get, you know, that's an insane position to be in. But at the same time, yes, you know, if that is about to unfold, I think you do want people on the phone talking and trying to figure out how to avert it. Now, at the same time, why is it that all of the people, the retail, the apes who were right, get penalized, and, you know, a firm like Robinhood and others don't, right? Then it's again the same sort of 2008 all over again, where they bailed out the banks and a bunch of mortgages got foreclosed on. Like, that was wrong. That was morally and ethically wrong. The people who got penalized are not the ones who should have been penalized. And I think we're seeing exactly that in this situation, and that's why it feels so wrong.
That's very interesting. It's almost to the point that it seems like all the people who society agrees knows about this structure and what's going on, they're all saying something went weird there. We don't know exactly the details, because right now, obviously, the SEC has not subpoenaed all the trades, the communications, like, or whatever government body would have to do that. But what's weird is, maybe I'm taking too many crazy pills, but the only people who are trying to tell us that it's okay are like the only handful of people profiting off of the current system. It seems like literally everyone else is like, oh, no. We dodged a very, very big bullet. And right now, mainstream media especially, they talk to us about like how we're so stupid, we're so wrong. And it's a big issue. Like right now, they almost try to make you feel bad of like, wait, you don't want to help minorities who want to trade? That like, are you being a racist, right? It's like, that's not what we're saying whatsoever. They try to distort it in so many different ways. And I don't know if someone who has not The only people who seem to be protecting this extreme amount of off-exchange trading are the people who are making money of it. Like, seriously, do you know of anyone else who's like, oh, no, I like the system this way?
Yeah, no, did you see I mean, I was tweeting about this yesterday and I said, on Thursday, I was like, I don't know a single person defending the practice who either isn't part of it today and making large amounts of money from it, or had been part of it in the past, and that's essentially where their fortune has come from. And again, even the firms that now defend it did not used to defend it when they were on the outside looking in. And a lot of very sophisticated firms who are on the outside looking in continue to make the exact same arguments that we're making. And part of the problem when you create a extremely complex and fragmented system as we have in the US, and you segment order flow like this into just a couple of firms, is that there is a huge advantage to scale, right? So a firm like Citadel or Virtu can make tighter markets at higher scale. And so they crowd out the competition. It's a system that naturally leads to monopoly or concentration, and extreme levels of concentration at that. And so that's the inevitable outcome of this system. And not only do you end up with concentration in terms of market share, but you end up with concentration in terms of risk. And so these firms become systemically important. Now, that's why the answer is let lots of firms compete for the order flow. Let 1,000 firms compete for it, not 2 or 3 or 7, whatever you think the number is, because it's, pretty much just 2. But they're trying to let a couple other firms in to make it look like it's kind of more competitive than it is, and keep the antitrust authorities off of us. But it's not. It's not competitive until you have 1,000 firms competing in the open, where everyone can compete over that order flow and spread out the gains. And so lots more firms can make money. That gives us greater diversity in terms of trading and markets, and it spreads out the risk. So you don't end up with that kind of concentrated risk in the system.
Interesting. So to the returning viewers, the new viewers, and knock on wood, let's hope some regulators watching this video, I think a lot of them could consume it and say, okay, I get that something like potentially catastrophic could have happened, and I get that a lot of people are like kind of just yelling. These apes are yelling out like, hey, we want this fixed. And right there, your first solution is, okay, we need more competition. We need to disperse the risk over many different players so we're not relying on one. But for the people who could potentially actually write new laws and governance related to all of this, I've seen from my research on you that you've talked quite a bit about how a nice alternative is what we're currently seeing in Canada. So for all those viewers, and like I said, hopefully regulators, could you go into a bit more detail of that market structure, of why it's better, and also how they can successfully take off so much trading from off exchange and get it on to lit exchanges?
Sure. Yeah, Canada, like pretty much every other market in the developed world, does not allow payment for order flow. And it imposes a higher burden on off exchange trading. And so what Canada has is something called a trade at rule. And this is a rule that the exchanges in the US have been pushing for a long time. In fact, it's one that I've been pushing for a long time. And, so sometimes the exchanges and I align, not all the time. They don't like me for other reasons. But, for this particular one, we agree on this issue. And a trade at rule simply says that when you execute volume off exchange, you are free riding that public quote. You are damaging that public quote because you disincentivize market making. And so to do that, you have to provide compensation for the damage. And that compensation is material price improvement. Okay, so if you're going to execute off exchange in Canada, you have to provide at least a full tick of price improvement, a full penny. If the spread is a penny wide, then it has to be a midpoint execution, at least half a penny of price improvement. So the minimum level of price improvement for off-exchange trading in Canada for small orders is half a penny. But for most, because it's sometimes you have penny spreads, but anytime you have more than a penny, it's going to be a penny of price improvement. That's a big deal. That's 100 mils. So we talk about prices and fees in US markets. We usually talk about them in terms of mils. 10 mils is a tenth of a cent. 1 mil is a hundredth of a cent. It's more of, sort of Wall Street jargon, but it's a convenient way to start to refer to smaller price increments. When you look in the US, the vast plurality, I should say, of price improvement in US markets, which is the price improvement Citadel and Virtu and the others are providing to retail investors, is 1 mil. So it's 1/100th of a penny per share. So a penny for a 100-share trade is the price improvement you get. And that to me is just absurd. And it does not justify moving that volume off exchange. So the Canadian model, I think, is a good one. Now, the argument is always to simply make fun of Canada. Honestly, like when you bring up this kind of argument, let's say on Twitter to Doug Sifu, he will laugh at you and he will say, "No, USA, USA. We don't want to be like Canada. Are you crazy?" But it's such a ridiculous argument, because when you actually look at global execution costs, now, the US market, I think I've said this before, the US market is the biggest. And as a result of that size, we look really good. But when you start to control for the factors like company size, you start to see that actually execution costs in other countries are lower than the US, because those countries are not as fragmented. Their markets are not as distributed across multiple systems. They don't segment their order flow. And those things mean that you get better execution quality. So instead of making fun of these arguments are grounded in math and they're grounded in common sense. And we should have, reasonable debates on them, but we should recognize that, because someone who's making millions and millions of dollars a year puts down the argument and makes fun of it, because he's incentivized not to, does not mean it's a bad argument. And I think this would be a very important rule for the US to consider. And I'm really hopeful that this new SEC regime is the kind of one that can take a stand and can actually make this kind of really big change. And I don't, sort of minimize the difficulty of coming out with a trade at regime, because you're coming out against extremely wealthy and powerful interests politically. And that has never been something that is easy to do in the US.
So before we get a little bit more into that, I get this. It's kind of a red herring argument of like making fun of Canada. But what's weird is people with influence, like I'm talking mainstream media that's getting views of millions. They're like, who else doesn't have payment for order flow? North Korea. Like, what? Like, I'm 27 and I feel my hair going gray when I hear the most idiotic statements such as that. So like, it's nice that people like you are willing to share it to get us all onto the exact same page of what's going on. But for me to summarize the Canadian trade at, just let me know if I'm wrong for people who maybe don't know not enough about market structure such as yourself.
Sure.
So it's basically, in the US, we have a system that says, trust me, bro, I'm going to get you a better execution. And in Canada, it's you only get that trade if you actually show it. Like, I feel like we're just trusting them.
That's the best summary I've heard yet. Yeah, you nailed it, man.
All right. So for everyone out there,
US is totally trust me, bro. I got this.
All right. It's just for everyone else there, I think we can that makes a lot more sense to most of us. It just seems,
and we all totally trust Ken Griffin, right? I trust that guy so much. Yeah, we can trust him.
It just seems wild because in Canada, they clearly have to show that it's a true improvement before the trade goes there. And here, it's the opposite. It gets to the lit exchange only if they don't want it. It's toxic flow. Like, they're going out of their way to be like, we have no edge here. Good luck on the open market now. Like, and it's the worst trades. It's insane.
Yeah, and so if you look at Canada, you end up with something like 7 to 8% total trading off exchange, relative as opposed to the US, where it's 45%.
Yeah, and then I just ran the math on some of the more interested stocks of like AMC and GME. It's pushing 60%. Not even half of the trades are done in the most regulated lit environment. They're all done in like a less regulated trust me bro environment, which is just insane. So with that being the structural part of the people who really nerd out about it, of like, okay, here's where we're going, a very fair question is, well, how do we get there? Because all of a sudden, an argument that I would argue is like the 99 versus 1, it seems like people are trying to cut it in half and make it super political. I mean, even with the GameStop report coming out, we had 2 of the commissioners, they didn't full on dissent, but they had commentary that they're like, we don't necessarily agree with this. And it's a certain point where it's tough to know if someone has a legitimate gripe or if they're trying to protect their own political and or financial interests. So with that being said, what's your opinion on like the proper steps forward? Because obviously the system should be fixed where it can't be brought to its knees by some weird systematic like black swan event involving like a video game seller. Like that's insane.
I know. It's insane. And I get very frustrated when, and this has been sort of the story of my involvement in my public involvement in market structure, where I generally believe that I am basing what I say on facts and objective analysis. I consider myself pretty independent. I do have, as I've said before, I've been compensated by IEX for like the 6 months or 9 months that I worked there in 2012, but my views had not changed. Like my views before doing that were the same as my views even to this day. They've evolved and matured, but like they're basically the same. And there are very few people out there, I think, who are able to give sort of this independent perspective on market structure. And it seems so crazy to me, but not surprising that politics becomes such a fundamental part of these discussions. And today, in this day and age, politics means partisanship. And that's even more of a shame because it actually wasn't like that, let's say, 5 years ago. It could be political, but you didn't really necessarily see it break down along traditional lines. Yes, like when I testified before the banking committee, the Republicans were much more skeptical of anything that might involve regulation, and the Democrats were generally more supportive. But my point has always been that the current system that we are in is one of regulation. Like regulation has created this current system. So making the argument that changing those regulations is actually introducing new regulations, I find to be very disingenuous.
Interesting.
This is a system that is born of a particular regulatory framework and structure, and to make adjustments to that is not like the democratic nanny state trying to destroy businesses. I think that kind of argument is one that Republicans will come in and make, like Toomey, for example, and the Republican SEC commissioners, because if they can make an issue partisan, especially in this day and age, they believe they can really split people, right? Like it's a sort of classic approach of wedge issues. And both parties are very good at identifying wedge issues and driving them in to split people apart. Whereas, if we take a step back and say, what are our principles of market structure that we should all be able to agree on? Those principles are transparency, an open competition for order flow, right? Like, and I think one should be simplicity, right? Like we want the simplest possible system, not the most complex, which is certainly what our current market structure has given us. So if we think about, regulatory changes as trying to peel away complexity and introduce transparency and open competition, I mean, those should be principles that nearly everyone can agree on. Those are not partisan issues. So I think that the SEC has indicated that it is going to be coming out with a proposal. It's going to be trying to act on payment for order flow and a reevaluation of our current market structure. And I think there are lots of issues that almost everyone can agree on in terms of better disclosures and transparency. And then there are going to be issues that are going to be a real war, and payment for order flow and off-exchange internalization is going to be that war because a powerful group of people make a lot of money doing it. And anytime you threaten something like that, it sets up to be a political war, and it's going to be driven by political donations and political influence, but also, hopefully, by this grassroots movement that can exert some influence and maybe be one of the reasons that we get positive change in market structure.
Interesting. So with it, reading through the report and even Chairman Gensler, some of his comments, it does seem like they're making some of the headway on settlement time. I'm a fan of that. You were even talking about the 13F like reports. I like that of like, let's get the shorts in there. I haven't heard too much about PDT, but maybe that's a battle for a different day. Same with FTD reporting. To me, it's too slow. There's really not like no information on who prompted it, no information on how they fixed it. To me, that's another one. But I also understand that like sometimes you have to pick your battle to win the overall war. So it seems like right now, the biggest and quote unquote best thing we could fix is the extreme amount of abusive off exchange trading. So if we're going that way, I just had this thought of, I myself say it as David and Goliath, the 99 versus 1. But in a way, I could actually almost argue now it's more extreme than that, as in everyone except for Virtu and Citadel Securities. And here's my thought. You even go to the world's richest people, you point them at their stock account and be like, how would you have liked it if that went away? Like in a certain way, we can almost like just, if you're in the market, you should care about this because it was that close to going kaput. So even if you have billions of dollars on it, you're still on our side, man. Like we're in a certain way, we are fighting for everyone involved in the market, exclusionary of Virtu and Citadel Securities.
I mean,
just even their greed.
Even those that aren't in them, right? Like people, this has impacts on people's jobs, right? It impacts companies' ability to raise money and to grow. It is a driver of economic growth. So, I would argue it's even broader. But yes, absolutely. Like if you look at the current participants in markets, you will have, the internalizers and the discount brokers on one side of this argument, and you will have everyone else on the other, right? The exchanges, the asset managers, the apes, even apparently the regulators. I think individual investors should be on the side of the issue that says, let's have open competition for order flow. Because while Citadel and Virtu are going to try to scare people, they're going to use scare tactics to say, you put those orders on exchange, you are not going to get price improvement. Everything's going to cost more. And I just think that is flat out false. And they have no evidence to back that up. They will say they have statistics because they will say, look, there's no price improvement on exchanges. No shit, there's no price improvement on exchanges. That's what happens when you put all the order flow over here, right? Yeah. You want to send that order flow to the exchanges, there's going to be price improvement. It's not like what Citadel and Virtu are doing are magic, right? The other market makers can do the same thing. This isn't magic. So you send that order flow to the exchanges, you try and reduce fragmentation, and we know that spreads will compress, so immediately execution costs will go down. And you would have 1,000 firms competing over price improvement. It honestly seems like a no-brainer to me. I agree with you that, everyone should care about this issue because it's not just about price improvement and execution quality. It is about systemic risk and the fact that our system has become relatively fragile, and that should really concern us all.
So if we're all on board with that, what, in your opinion, is it to the point where we need to talk to government, like find the ear of a congressman, woman, a senator, something that's going to listen to us? Because obviously at a certain point, it seems like we're kind of getting pushed off, like we're just the crazy people, like let's keep them in the corner. But to show that we're serious, like I'm too new to know about like, okay, how do things really get done politically? But do you even have thoughts on that of like how to elevate our argument to at least the people to like for us to have a fighting chance?
Yeah, I've spent years advocating for these issues. I have met, I've testified before Senate Banking Committee, but I've met with members of Congress. I've met with their staff many times. I've met with regulators many times and talked about this, all of these exact issues for a long time now. I will say that I am extremely skeptical about anything with Congress. I don't think Congress is going to do anything here either way. There just aren't the votes, and really, they don't seem to care. Now, maybe they can be made to care, but usually Congress responds only to campaign contributions and PACs. And so uh, I don't know that that's the route that personally I would think is fruitful. There are bills up in the House to eliminate payment for order flow. Senator Toomey just recently announced a bill to protect payment for order flow. I honestly doubt that either of those bills has enough votes to make it past, let's say, a Senate filibuster, and to actually be enacted into law. What I do think is a very promising avenue is the advocacy and speaking with regulators. I think that the answer is going to come from the regulators on these issues. And I do think we're going to see something soon. The SEC and Gary Gensler have been indicating this for quite some time, that they are going to make a move. And when they do, there's going to be a war. And to me, that's where to fight the battle, is to back up. If the SEC comes out with something aggressive, that's when the political machine will crank up. And that's where the grassroots movement needs to step in and to take the other side of it and to say, no, we care about this issue, we understand this issue, and we want to be we want to be constructive about how to approach and solve the issue, right? And I think if we can do that, there's a real chance for some substantial material change here.
And for a point of clarification, the next, I guess, like batch of comments from the SEC is expected to come out roughly mid-November, right? Like, is that the next, like, obviously this is a long litany of comments and back and forth, but that's the next one where you're expecting to hear about these rules as they relate to payment for order flow?
I'm not 100% sure on the timing, but I do think that the SEC will come out with some kind of proposal next month. Yeah, from what I'm hearing and some indications, it's coming soon.
Okay.
I think it'll be before the end of the year. And yeah, so if it's next month, what will happen is the SEC will propose, hopefully. So there are two things they could really do. They could essentially open a comment file. There's still like a 2010 comment file on market structure that is open. And so many of the times that I have advocated for things with the SEC, I've done it through that comment file where I could file a comment letter and then I could meet with regulators to discuss that. But what I think is going to happen instead here is, instead of sort of this request for comment, I hope they're actually going to come out with a rule proposal. So the rule proposal will be very specific. It will say, hopefully we're going to ban order routing inducements. So that's not just payment for order flow, but that's also exchange rebates. That would be ideal to see that. And we're going to propose a trade at rule. So if those two things are in a rule proposal, the war will be intense, because those are two really fundamental parts of U.S. market structure today. And so then that will open up a comment period, and that will last. I mean, for something like that, it'll probably be a couple of months of a comment period. Then the SEC will have to get all the comments, and there is a very distinct process that is prescribed by law for what they have to go through to evaluate those comments, look at every single one of them, and then make a final proposal, which might be different from the initial proposal. And so that's the process that these arguments will play out. And again, this is the kind of thing where if people can come together around reasoned arguments to support what the SEC is going to try to do, or even push them further, then that can be a very effective way to advocate before regulators.
Well, as that war gets going, obviously I'm excited to bring you back on as we're giving a live by live play. Speaking of a different type of war, though, it seems like Citadel Securities is continuing its never-ending war with IEX, which, for those of you who don't know, is a lit exchange, and they were created back in 2012 to basically battle high-frequency traders. They have a special type of order called the delimit order, and the high-level view is it helps battle against latency arbitrage. Citadel Securities is currently suing the SEC. It happened on the 25th was the court case, and right now they're deliberating on it. And they're saying the SEC didn't follow the proper steps in approving that. with that particular war, Citadel Securities versus IEX, could you give us your thoughts on that? Maybe explain to the audience what latency arbitrage is and how you think things are going in that particular battle?
Sure. So yeah, Citadel has fought IEX every step of the way. They were sort of the most vocal opponent of IEX becoming a stock exchange. They opposed what IEX did to start out with, which was this coil of fiber that introduced 350 microseconds of latency before your order could get to the IEX matching engine. IEX, and as I mentioned earlier, I worked with IEX in its very earliest days before it was ever a stock exchange. Helped both on the technology design side of things as well as sort of thinking through how high frequency works and how high frequency traders interact with exchanges and ways to mitigate some of those speed advantages that other exchanges had sold to high frequency traders. And so, Citadel did not like any of that. They did not like any of the protections that IEX offered against latency arbitrage. So latency arbitrage is what basically Flash Boys described. So the book Flash Boys, which was published in 2014 by Michael Lewis, described both the establishment of this very fast fiber optic line between New York and Chicago called the Spread Networks line, as well as the development of IEX and the sort of saga of the fight to build an exchange that was focused on long-term investors versus high-speed traders. And latency arbitrage is basically when high-frequency trading firms are faster than the stock exchanges and faster than other participants. So there are multiple data centers in New Jersey where the stock exchanges servers exist. And so if you are a high-frequency firm at one of those data centers and an order comes in and you execute against that order, if your model tells you that that is a piece of an order that's probably transiting other telecommunications lines to other data centers, you might race ahead of those orders in transit, cancel your orders that are sitting at the other exchanges, and lift up the offers or drop the bids in order to make those orders pay more to execute. And so what latency arbitrage does is it increases adverse selection on exchanges. It increases the cost for institutions, for slower institutions to trade. So IEX set out to fix that by first introducing this coil of fiber, and second, creating order types that would use the same equations and models as high frequency trading firms, right? So if the algorithm that IEX built thinks that that price is about to drop, just like the high frequency firm thinks that price is about to drop, it will turn your order off and drop it for you. And so originally that was based on a midpoint peg, but it was non-displayed. Then it was based on a resting limit order, non-displayed. Ultimately, they came out with this delimit order type, which is a displayed order type. But it does the same thing. I realize I'm using a lot of jargon here. I'm trying to be succinct, but I think what you need to know is that displayed order types are the orders you see on the order books, and what IEX did was so if you post a bid at $10 and their algorithm says, hey, the price is about to drop, then that bid will drop to $9.99. That's all. And it protects that resting order from those faster high frequency firms. And it sort of adheres to this principle that an exchange should be faster than its fastest participants, which is something that no other exchange in the US adheres to.
So to sum that up for the highest level people, basically IEX has come up with a system where they feel as if they could predict something high frequency traders are about to do. And if that's going to be adverse to you, they fix your order to make it a little bit better. So they're basically it's like a reverse Uno card on high frequency traders. They have the models, they're going to do it, they do it, and instead of high frequency traders profiting, they're helping people on their exchange get a better fill, or basically like that.
Yeah. I think that's a good sort of high level overview. It's the exchange working to protect its resting orders and avoid those super fast orders that are coming in to try and find stale prices. So what it really is, and Citadel's argument against it, is that um, they should be able to basically transact at stale prices. They should be able to pick off those resting orders because they can do it on every other exchange. But what IEX is trying to say is no, we're reflecting the actual price. We just happen to be faster than them because we've pushed them off. We held them over here while we update the price and then we let them in, essentially.
Gotcha. So with that, though, this has already been, you could use it right now. I believe it's been live for about a year. It's been
approved.
Yeah, now that we're filming this, it's been going there for a year. So obviously the SEC has previously approved this type of market order for IEX. And right now the court case is Citadel Securities suing the SEC that they should have never allowed it. And this is where I get confused, because it seems like within the case, they were arguing about the definition of instantaneous, immediately, and they like to throw out the word de minimis a lot. But in reality, it seems like they never made an argument about SEC procedures. They just argued about the speed bump that IEX has. So to me, it was a poor legal case, but I'm not a lawyer, folks. So I've barely watched all his suits, so don't take that as legal advice or anything. But did that confuse you at all?
It did. And again, same here, not a lawyer, not even close. But my understanding is that just because a regulator does something you don't like, doesn't mean you can appeal it. The only thing you can appeal is, did they go through, as I described earlier, the prescribed process for putting the proposal out there, receiving the comments, reviewing the comments, doing their analysis, and coming up with a solution. If you think that the regulator didn't do that this decision was arbitrary and capricious, which is the legal standard, which means Gary Gensler was like, I hate Ken Griffin, approved, stamp, then you can sue them. If he didn't do that, you really don't have a leg to stand on. And, so the lawyers that I did talk to, they all pretty much told me 99% this is an SEC and IEX win. And again, I'd like to mention that as I described latency arbitrage, and I said it was how, what was described in this book, Flash Boys, when Flash Boys came out in 2014, the entire industry mobilized against it. And the entire industry came out, all of Wall Street, and said there is no such thing as latency arbitrage. This is a work of fiction. This does not exist. And lo and behold, 7 years later, the Citadel lawyer admitted that latency arbitrage existed. He tried to say not now, but 10 to 12 years ago, sure. But that was the first time any major firm had admitted latency arbitrage existed. And the SEC came out and admitted latency arbitrage existed. So it was, from that perspective, even though the court case is probably an open and shut case, it was extremely exciting for those of us who had been talking about this for many years to finally hear these people saying, yes, okay, we see it.
Wow. It almost seems to be in that same vein of thought of in 2004, you had a Citadel arguing payment for order flow is extremely bad. We shouldn't use it. It will be detrimental to our Wall Street system. And now they're obviously defending it. It makes them billions of dollars a year. But I find it so funny of Mr. Ken Griffin. He'll go on TV and say, what's his argument? He's like, just tell me what side of the road to drive on. I'll drive on it. Well, I don't think he's that willing to back down because it's such a revenue generator for him. And if he was so willing, if he was so just Mother Teresa altruistic, I'll just drive on the right side of the road. At that point, well, why not just do it when there's a legit, he has the data, he knows what he's doing, but yet he'll just go on TV and say his piece and like, oh no, I'm fine, just tell me what to do. Well, if you're that fine with it, I don't see why people like Senator Toomey are trying to protect it then. The dude just admitted he's fine with driving however he wants. Man, super strange everything that's going on right here, but
for sure,
it is cool to know that hopefully in the near future we're going to get the next step in whatever this like legal, social, cultural battle is. So I mean, before, I know we should have never held our breath with the SEC or anything that they're doing, but fingers crossed, because that's all we can really do. But as that goes, I 100% agree with you that our movement, the apes, like we got to make our voice being heard, whether it's just OTC, not for me, showing up, listening to these court cases. clearly with millions of people, it's a gigantic megaphone. And I don't know, I'm feeling optimistic, cautiously optimistic, but let's see how this all ends up playing out. Obviously, as it develops, I'm more than excited to bring you back on. Your Twitter is going to be under you this entire interview. So if people want to follow you, stay up to date with what you are or aren't saying, follow that on Twitter. Also, I know you've been involved with your project, Terminal. Guys, you got to check that out. We've discussed it in more detail previously, but one of the biggest issues being a retail trader really is our lack of quality data, and that's exactly what Mr. Lauer's project is attempting to fix. It's trying to give us actual useful information akin to what institutions have. Is there anything you want to say to the group before we let you go today?
No, I think that was you said it great, and I agree. I think that this movement can really make a difference, and I'm thrilled that people are interested in hearing what I have to say, and I will keep saying it. And like you said, the terminal is our attempt to try and fix part of the system. And we're also in the midst of a crowdfunding campaign, so you can actually invest and own a piece of it. We really that's the model that we wanted to adopt, was to give the community equity in the company. And so if you go to my Twitter page, it's the pinned tweet, you can check it out. And that's it. Just happy to be here, and happy to come back to keep talking about this. Thanks, Matt.
Yep, we really appreciate your time, and we'll be talking soon. Have a good one.